let's talk interest rates. We pay interest rates on our credit cards, on our houses, even our cars. But what exactly is it? And where does it go? Why does it fluctuate? An interest rate is the percentage charged by a lender to a borrower for the use of money over time. So when you take out a loan, whether it's a mortgage, car, or credit card, the lender charges interest as the cost of borrowing. The interest rate determines how much extra you'll pay on top of the loan over the amount of that particular time. Now, interest rates can also apply to savings accounts, certificates of deposits, and bonds, and that rate will determine how your money will grow over time when you deposit or invest it. Central banks, like the Federal Reserves, they set benchmark interest rates to influence the overall economic activity. So, for example, higher interest rates can slow down borrowing and spending, while those lower rates can help stimulate it. So if inflation is high, the central bank might raise the interest rate to kind of cool down the economy, but they might use lower rates to kind of encourage spending when inflation is low. For individuals, the interest rate on a loan, especially large ones like your mortgage, significantly impacts how much you end up paying over the life of your loan. So a lower rate might mean lower monthly payments and less overall costs, while higher rates often lead to higher returns on savings and investments, so that makes savings a little bit more attractive. By adjusting these rates, honestly, the Federal Reserves try to maintain economic stability. They aim to control inflation, stimulate economic growth, and this even influences employment levels. And as a realtor, I can tell you that these interest rates play a crucial role in the housing market. So when our rates are low, borrowing is cheaper, which can increase the demand for homes. But higher rates can kind of reduce affordability for some buyers, so potentially slowing that market down. As of late, August 2024, the average mortgage rates were, listen to this, 6.4 for 30-year. 15-year rates were 5.6. These rates have fluctuated throughout the year, yes, but they've remained below 7% for several months. Factors influencing these rates include the Federal Reserve's monetary policy, inflation trends, and just the overall market conditions. The Fed's potentially have even more rate cuts later this year that can influence our mortgage rates. But the last time we saw 7% mortgage rates, this was in 2023, late 2023. Specifically, those rates reached nearly 8% during the second half of the year. They remained consistently above 7% until at least December. That's when they finally began to decline, dropping below 7%, and they stayed below that threshold all the way into 2024. So now might be as good a time as ever to buy a house for a couple of reasons. After that period of high rates in 2023, mortgage rates have actually stabilized below 7%. So while they're not as low as they were during the pandemic, they are lower than the peak rates that we saw in 2023. So this is providing an opportunity to secure financing at a more manageable rate before any potential increases or market changes. The Federal Reserves have indicated that there's a possibility of rate cuts later this year. Now, if that rate drops even further, buyers who secure a mortgage now might actually be able to refinance at an even lower rate at the future. And so this can make homeownership even more affordable over time. Depending on where you're at really in this market, some areas are experiencing slower home price growth and even a slight decline. So this can present opportunities to purchase a home at a more favorable price, specifically if you have motivated sellers. In some markets, there's a healthy inventory of homes for sale, which means buyers have more options and potentially more negotiating power. So this can lead to better deals or even incentives from sellers who are eager to close. So if your personal financial situation is stable but has good credit, solid down payment, job security, it might be an excellent time to invest in a home, especially if you plan on staying in that property for long term, because this can help build equity over time, particularly when our values appreciate. So overall, while the rates are higher than historic lows a few years ago, the current environment offers opportunities for savvy buyers who are just prepared and ready to make that purchase.